Hello, and welcome to the first edition of XPS News. We are currently living in unsettled times. The coronavirus disease outbreak, now classified as a pandemic, is having a significant impact on our economy, on our health, and on our social environment. Given the market uncertainty and also the change in population behavior, it is now starting to impact every aspect of running a pension scheme. With that in mind, Simeon and I wanted to share with you actions that trustees and employers can take now to respond to this and protect their pension scheme while looking after their members.
So we were always expecting March to be a busy month for pension schemes. We had the regulators' consultation in relation to the funding code, we had the government's consultation in relation to the retail prices index, and we also had the budget. But what we didn't bargain for was the impact of coronavirus. And this has had a substantial impact on markets and on pension scheme funding levels. So what's been the impact? Well, assets are down. We've seen an equity market fall of about 30% over the last month. And we've also seen liabilities rise by about 10% over the same period. Now, this has been the result of a flight to quality, people buying low risk assets, but also central bank activity, with the Bank of England reducing the bank rate from 0.75% to 0.25%. The overall combined impact of this we've estimated on our online tool Radar as being an impact on a typical pension scheme's funding level of 7%, a fall of 7%, which demonstrates the magnitude of this impact. And this isn't over yet. This is fundamentally different to previous crashes and crises that we've seen. If we contrast it with the tech boom and crash in the early 2000s, that was overpriced assets. The global financial crisis in 2008 was the result of excessive risky lending. But what we're faced with here is a shutdown of the global workforce, a partial shutdown. And that could have a really substantial impact, not only on the level of funding of pension schemes, but also on their sponsoring employers. And this is something that we need to be very conscious of over the coming months.
So with such potential severe consequences, what can trustees and employers do now? So first and most important is check the impact on your funding position. We are doing that for our clients using our online proprietary software Radar and helping them understand how resilient their investment and funding strategies are. Secondly, understand how the employer is affected. Pension schemes ultimately only fail when their employer fails. So understanding how the employer is impacted is important. And unfortunately, some industries are more exposed, such as hospitality and travel. Thirdly, review whether there are opportunities. We are finding that for some schemes, the cost of transferring risk to the insurance market is becoming cheaper, especially those with significant gilt assets.
On the asset side, there's a range of things to consider, but we wanted to highlight a few that are very poignant. So the first is, if you've got a plan to increase hedging, you shouldn't stop just because the market levels have fallen. The prices are less attractive, but there's no reason to expect that gilt yields will improve from here on, and so you shouldn't be reducing that plan to take risk off the table. Further, if you've got a plan to sell equities as part of your strategic allocation to reduce risk, you should think about continuing with that plan, because the equity risk is substantial, and just because we've seen market falls doesn't mean we can't have further market falls. We're probably only about halfway through the sort of magnitude of impact that we saw back in 2008 or 2001, and so this is the sort of level that you should still be thinking about taking risk off the table. And then lastly, perhaps a little bit of good news, is that within your credit portfolio you could use this as an opportunity to extend the duration of your credit assets, because we've seen a rise in credit spreads, which means you earn a higher return for holding that risk, and you can extend the maturity of those bonds and lock into that higher credit spread for longer.
Trustees should also think about communicating with members. Members may be concerned around the current environment, and trustees should have a strategy for when and how to engage with members. Trustees will not want to worry members or alarm them by engaging too soon, but as circumstances develop, trustees should be ready to say the right things at the right time. Members will also be thinking about their options, and members exercising options can impact on the funding position of a pension scheme. So observe member behaviour, look for significant numbers of increased activity, and also, if you are carrying out a bulk exercise with the employer, review the terms of that exercise and whether it is still a sensible program to progress with. We've also seen the regulator issue a statement to trustees encouraging them to look at their business continuity plans, and trustees need to have a plan to continue to be able to govern effectively. Working remotely, being able to have conference calls, video conferences to engage with other trustees and with your advisors will become ever more important, and those plans can ensure you can continue to run the pension scheme.
So to sum up, we think pension scheme trustees and corporates should be assessing their current position, engaging and discussing with the various stakeholders on what the implications are for your position, and then acting on those discussions.
So thank you very much for watching. We will continue to keep you updated as things develop and progress, and please do check in on our website where we will post updates to these news items.